A new tech company just hit the Tokyo Stock Exchange, but this is not your typical tech stock. So here are the basic details on the IPO. Now let's dig into what makes them so different. You see 95% recurring revenue and you think, okay, standard SaaS company, right? Not so fast.
Well, that's actually a huge mistake. Here's why you can't just slap that SaaS label on it.
See, they have a playbook built just for Japan, with 3 key moves. First up, hybrid management. Basically, one stable business is bankrolling a newer, high-growth one.
Second, their fabless model. They outsource R&D, which makes their costs flexible and seriously helps their margins.
And third, number 3, logic. They don't fight giants like Microsoft, they just win in the niches.
Okay, so you've got this unique strategy. What does that actually do for their bottom line?
It creates something really powerful. It's called negative churn, and it's a huge deal.
And check this out. They actually make more money from their existing customers than they lose from cancellations.
That right there is how you get negative churn. Their customer base is literally a growth engine.
This means the company grows on its own, even without signing up a single new customer. But does this awesome stability come at a cost? You bet. Let's look at the risks. The biggest one, they are super reliant on just one development partner for, well, everything. And this brings us to a major disconnect between what the company says and what it's really like.
In their IPO filing, they talk a big game about being Japan's #1 security innovator.
But then you read employee reviews and you hear about a culture that hates remote work. So you gotta ask, can this old school culture really deliver the modern growth they're promising investors? Because of this split personality, you just can't value this company like a normal SaaS rocket ship. So you need a different framework. You have to focus on profits, cash flow, and local competitors. If you're watching this stock, here are the 4 numbers you absolutely have to track every quarter. And listen, if that net churn number ever turns positive, that's a massive red flag. Which leaves us with a big question. Can a traditional company really pull off a modern growth strategy?